Hey everyone, how's it going? This is Arindam, and today we will be discussing about the different types of mutual fund there are and what does each fund stand for. You should watch this video as a guide that would help you choose the right type of mutual fund, because when someone tells you to invest in a mutual fund, that statement is very vague because different funds have different risk profiles and have different areas of investment. So you should know all that before you go ahead and invest in one. Now with each type, I'll be telling you where do they invest their money, what is its last 5 years average return, what is their risk profile, what's the taxability, and what is the average investment duration you should be looking at. So broadly, there are three types of mutual funds based on the area of its investment: equity mutual funds, debt mutual funds, and hybrid. Now there is also one more category that is comparatively rare compared to these three categories, that is commodity mutual funds. Now coming to equity mutual funds, these funds primarily invest in the equity shares of companies, and there are various types under equity mutual funds as well. So first off, we have sectoral mutual funds and thematic mutual funds. Now sectoral mutual funds are ones which invest in a particular sector. For example, you have the IT sector or the healthcare or the pharma. These funds would primarily invest in companies belonging to this particular sector only. And thematic funds are the one which invest in themes. So to give an example, if a fund invests in the theme of infrastructure, it would invest in sectors like cement, theme, and power. So an infrastructure themed mutual fund would invest in companies belonging to these three sectors. And you can say that a thematic mutual fund is slightly broader when compared to sectoral mutual funds. Now next off, we have index mutual funds. Now these are the ones which replicate the return that is given by an index over a period of time. So for example, if Sensex over a 10 years period gave a return of 13%, an index mutual fund would invest in companies in such a way that it would also try to generate a return of 13%. And ELSS, or equity-linked savings schemes, also invest majorly in equity, but the special feature of this kind of fund is they provide a tax advantage. So the investment that you're making in an ELSS fund, whether that be in the form of a lump sum or SIP, you can claim the same as a deduction when you're calculating your taxable income at the end of every year. Next off, we have large caps, mid cap, and small cap companies. Now when you're talking about equity mutual funds, these three terms are the ones which you would come across more often than not. So what does cap mean here? Cap here means capitalization, which is basically the market valuation of the companies. So large cap companies represents those companies which have a market valuation of rupees 20,000 crores and more. Mid cap are the ones which have a valuation ranging between 5,000 to 20,000 crores. And obviously small caps are the ones which are below 5,000 crores. Now, as evident from the name, large cap mutual funds obviously invest in large cap companies, and the same goes for mid cap and small cap mutual funds. But what does this mean for you? So since a large cap mutual funds invests in large cap companies, and these companies have been performing quite well for the past few years, and because of which they are stable companies compared to the other two categories, a large cap mutual fund is the least risky out of these three. And the opposite can be said for the small cap mutual funds. Since they invest in small cap companies, a small cap mutual fund is the most risky within these three. But again, a small cap mutual fund has a capability of giving you more returns, because small cap companies are relatively smaller companies which have more capability to grow in the future, and hence more capability to generate returns for you. And that's why small cap mutual funds have the capability of giving you very good returns over a long period of time, but they are risky and volatile over a short period of time. Now in November 2020, a new category was introduced in equity mutual funds known as the Flexi Cap Funds. Now these funds are not restricted to any particular type of capitalization, and they can switch between large, small, and mid depending on the market scenario and how that particular sector is performing. So a Flexi Cap mutual fund gives more freedom to a fund manager to generate more returns for you because it's flexible. And lastly, we have focused mutual funds. These are the ones which have a mandate from SEBI. That is, they can invest in a maximum of 30 stocks and not more than that. Normally mutual funds invest in a minimum of 50 stocks or more, but these have a mandate wherein they cannot exceed 30 stocks. These stocks can be from any particular sector or any particular capitalization as the fund manager chooses, and they are really focused on those particular 30 stocks. Now moving on to the next category, we have debt mutual funds. These are funds which primarily invest in short-term and long-term fixed income securities. So what are fixed income securities? These are the securities which will generate a fixed return for you at a particular frequency. Now this return is normally in the form of interest. Now to give some examples of fixed income securities, we have corporate bonds, debentures, commercial papers, certificate of deposits, etc. So a debt mutual funds invests in these kind of securities so that they can give you a fixed return every year. And because of the same, they are less risky when compared to equity mutual funds, and consequently they have lesser returns as well. Now coming to the subtypes within debt mutual funds. So first off, we have credit risk funds. Now the objective of this kind of funds is to outperform the other types of debt funds in terms of returns, and hence they invest majority of their money in low-rated fixed income securities. These kind of securities have a high chance of default, and hence they carry a high rate of interest as well. And also because of which, this type is one of the riskiest in the debt mutual fund category. Next up, we have corporate debt funds. These mutual funds invest at least 80% of their money in fixed income securities which are issued by companies which have a very high credit rating, which means there is a minimal chance of default because these are financially strong companies, and because of which they got that good credit rating in the first place. Next up, dynamic debt mutual funds. These mutual funds invest in debt instruments of varying maturities. So what this basically means is the fund manager here can shift between a short duration and long duration debt instrument depending on the interest rate movement in the market. They do this so that they can give you a higher return compared to the other categories. So that's why it's dynamic in nature, because it can shift between long duration and short duration debt instruments. Banking and PSU debt mutual funds are one of the common debt mutual funds, and as evident from its name, these funds invest at least 80% of its money in debt instruments issued by the banking or the public sector unit companies. GILT funds. Now these are the funds which invest in securities which are primarily issued by the central and state governments, and hence these funds are really safe and carry almost no default risk because these securities are issued by the central and state governments. And lastly, we have money market, liquid and overnight mutual funds. These are the ones which are really liquid in nature, and they majorly invest in short-term debt instruments. So if the fund invests in instruments with a maturity of up to 1 year, they are called money market mutual funds. If they invest in instruments with a maturity period of up to 91 days, they are liquid funds. And if the maturity period comes down to 1 day, they are called overnight funds. Now the purpose of these funds is to provide you with liquidity. So if you have some excess cash lying around and you want to park the same for a couple of days or weeks or months, you should consider these types of funds. And within these three, overnight funds are the ones which is least risky because they invest in securities which have a maturity period of 1 day, and the chances of them defaulting is almost nil. So that's the least risky out of these three, and in fact out of the entire range within debt mutual funds. The third category that we have is hybrid mutual funds, and these are the ones which invest in a combination of both debt and equity. Within hybrid, we have equity-oriented funds and debt-oriented funds. So within equity-oriented, these funds have at least 65% component of their investment in equity and the rest is debt. And with the debt-oriented, it's the opposite. They have 65% in debt and the rest in equity. Then we have monthly income plans. Now these plans generate income for you in the form of dividend or interest, and accordingly they invest in debt instruments, and also they have a component that is invested in equity because the dividend is generated from there. Now these funds, it's not as regular as it sounds, so there's no guarantee that you would get a monthly fixed income every month, because these funds pay you a dividend only if that particular fund makes profit. If not, they won't give you a dividend, so your monthly income would come down. So that's how this fund works. And anyways, if they have a component invested in equity, you cannot expect them to be regular when it comes to generating monthly income for you. But they do give you a monthly income, which the other funds do not. Balanced advantage funds are the ones which is quite interesting in nature, because these are the ones which is dynamic in nature. That is, they can shift between debt and equity as and when required based on the market condition. I have made a separate video regarding balanced advantage funds, and you can check the same one out if you want to know more about this kind of funds. And lastly, we have arbitrage funds. Now the term arbitrage means buying and selling a particular item in different markets and making riskless profit out of it because of that item's different pricing in those markets. So to give an example, say you have share A which is priced at ₹100 in the cash market, that's a type of market, and the same share is priced at ₹120 in the derivatives market, that's another type of market. So if you want to make a riskless profit here, you buy that share for ₹100 from the cash market and sell the same in the derivatives market for ₹120, and you have made ₹20 worth of profit, which is riskless. So don't get bothered by the terminologies used here. Just remember that this is what basically an arbitrage mutual fund does, because if I go on to explain those terminologies, it would take a lot more time. Yeah, so that's what basically an arbitrage mutual fund does. It generates return for you based on the profit it makes from arbitrage. And last off, we have commodity mutual funds. These are the ones which invest in a particular commodity and generate returns for you based on the performance of that particular commodity. So they can invest in gold, silver, or any other commodity. Now these are rare in India, and majority of the commodity mutual funds you would find are gold mutual funds in India. And these kind of funds, they invest in gold through the gold ETFs. And of late, silver mutual funds have also started coming up. Now if you want to invest in the commodity of gold, I have made a detailed video regarding that, and if you want, you can check that one out here. Now coming to the major heads, this is what the risk order looks like. Equity is the most risky and debt is the least risky. Now if we go into the subtypes within these three categories, this is what the risk order would look like. So in the respective categories, in the top you will find the most risky type and the bottom is the least risky. Now this order of risk profiling is obviously not absolute, because different types of risk is applicable to different types of funds. But for the knowledge of the retail investors who do not want to go into much details as to the different types of risk there are, this is just to give you an overall idea as to what is the most risky and what is the least risky, so that you can head to the desired place based on the risk appetite that you have. And if I talk about returns, this is what these funds gave in terms of average annual returns in the past 5 years. Now again, one very important point which you should keep in mind here is this is a past performance, and there is absolutely no guarantee that these kind of funds will give these returns in the upcoming future. And moreover, when I talk about equity mutual funds, they have an equity component in them, and hence the returns for equity mutual funds are slightly inflated because of COVID. And in any case, you should not choose a mutual fund based on just its returns. Now coming to the duration, this is what your average investment duration should look like if you want to invest in any of these categories. You can pause the video and take a snapshot, and you can invest accordingly based on your investment duration. Now, when it comes to taxation of mutual funds, there are two types. First off, we have long-term capital gains, and then we have short-term capital gains. But the definition of these vary depending on the type of fund. So if I talk about short-term capital gains, for equity mutual funds, if you sell off your investments within 1 year, that would qualify as a short-term one. And for debt mutual funds, if you sell off your investments within 3 years, it would qualify as short-term. And when it comes to long-term capital gains, the period changes as well. For equity mutual funds, if you sell off after 1 year, that's long-term. And for debt, if that's after 3 years, then it's long-term. Now, when it comes to the taxation rates for calculating your exact tax, this is what it looks like for equity, debt, and commodity mutual funds. You can pause the video and have a look. But there is something to be said for hybrid mutual funds. So for hybrid funds, as you can see here, for these 4 types, they are treated accordingly what is mentioned. Now, when it comes to balanced advantage funds, mostly they are treated as equity mutual funds, but there are cases when they may be treated as debt funds as well. Now, since balanced advantage funds are the ones which keep shifting between debt and equity, it depends on what's the percentage of debt or equity at the time of your redemption. So a way to check that is when you're redeeming your fund, if security transaction tax is charged, which is only charged for equity component or equity shares, that means then the taxability of these funds would be like that of an equity mutual fund. And if security transaction tax is not charged at the time of your redemption, then the treatment will be similar to that of debt mutual funds. So go ahead and invest confidently in mutual funds now that you know all these aspects related to them. To check out why should you consider doing an SIP, click here, and to find out an easy and convenient way to invest in equities, click here. That was it for this video, and until the next one, take care, see you, and bye bye.